Gold is engineering a massive trap today. My bias is aggressively bullish, and my primary focus is a precise long setup targeting a major external liquidity pool. But most retail traders are looking at the exact wrong level right now. Let me show you where institutions are actually positioning their capital. 4542.00. This is the primary buy-side liquidity target the algorithmic delivery is drawn toward. It's not a random level. It's a highly engineered pool of resting buy stops, sitting right above recent equal highs. This is the exact magnet pulling institutional order flow today.
We remain fiercely bullish on gold as long as price stays above the 4,500 handle. On the 4-hour chart, higher time frame market structure shifts have unleashed aggressive institutional buying. We've completed a multi-month corrective decline, printed a clear higher low sequence, and we're now expanding upward with undeniable displacement. The drawn liquidity is exclusively to the upside. Here is the exact executable trade plan. We're stalking a long entry strictly within the 45.22 to 45.26 zone. The hard stop loss is anchored at 45.14. Our initial take profit is that 45.42 liquidity pool, locking in a 1 to 3.2 risk to reward ratio. But listen closely, there is one non-negotiable condition that must happen before a single dollar is risked. To understand this condition, you have to read the tape across timeframes. While the higher timeframes are in complete institutional control, the 15-minute chart is stalling. It is deliberately engineering internal liquidity. The Asian session trapped traders in a tight consolidation range, building up stop losses on both sides of the market. Smart money is preparing to use that resting liquidity as fuel. Institutions target these external liquidity pools, specifically the resting buy stops above 45.42 because they require massive counterparty volume. Smart money cannot exit their longs or scale into new positions without this liquidity. Those resting stops are the exact fuel required for their upcoming distribution phase. But before they attack that high, they routinely engineer a purge of internal sell-side liquidity. Right now, there are highly vulnerable sell stops resting just below the 45.18 to 45.10 area. Market makers will often drive price lower to sweep these internal stops, pulling price into a deep discount to fill heavy institutional buy orders. This is why stepping in right now is a complete gamble. Price is hovering in a premium zone. We have zero institutional confirmation yet. Hitting the buy button here means you are entering at a premium price right before smart money potentially drops the floor to clear out early retail longs. We sit on our hands and wait. This brings us to the optimal entry zone. The 15-minute fair value gap between 45.22 and 45.26 is our highest probability discount array. This is the specific algorithmic footprint we need price to trade down into. It represents a clear imbalance in price delivery that the algorithm will naturally seek to rebalance before continuing the macro expansion. Execution is entirely dependent on 3 strict algorithmic steps. First, price must retrace deep into that 15-minute fair value gap. Second, this drop must violently sweep the internal sell-side liquidity we just identified. Third, and absolutely critical, it must immediately deliver a 15-minute bullish market structure shift with obvious displacement back to the upside. If we don't get all 3, there is no trade. Once triggered, this is how we aggressively manage risk and scale out. We take our first partial at 45.42, instantly moving the stop loss to break even. The second target scales out at the higher timeframe expansion level of 45.55. Finally, we leave a small runner for the deeper institutional liquidity pool sitting up near 45.70. But here is the problem. The current market structure is a perfectly designed trap for retail participants. If you don't understand the algorithmic draw on liquidity or the absolute necessity of a discount array rebalance, you'll be chopped to pieces reacting to every minor candle fluctuation. Retail traders are completely ignoring the lower time frame narrative. They are buying the false breakout early out of pure fear of missing out, or they're getting destroyed trying to scalp the Asian range. Smart money is doing the exact opposite. They're waiting patiently to sweep those internal stops and secure a heavily discounted entry. Retail will get stopped out mere minutes before the real move to 45.42 begins. The catalyst for this manipulation is already scheduled. We have US flash PMIs dropping directly in the New York kill zone, layered with intense macro narratives like rising Middle East tensions and a rallying oil market. Understand this, smart money doesn't trade the news. They use the volatility from the news to deliver price rapidly to their predetermined liquidity pools. However, every professional setup requires a hard invalidation point.
If we print a strong 4-hour candle close below the 4,500 level, this entire bullish thesis is completely invalidated. That would signal a severe shift in institutional order flow, pointing to a much deeper retracement toward 4440. If that happens, we immediately step aside. Let's quickly lock in the exact plan for today. The daily and 4-hour bias remains strictly bullish. We are stalking the 4522 to 4526 zone for a long entry, but only after a 15-minute liquidity sweep followed by a bullish market structure shift. Keep your risks strictly capped between 0.5% and 1% per trade. Wait for the New York kill zone and refuse to execute until the algorithm shows its hand. If you demand institutional-grade market analysis utilizing ICT and smart money concepts, subscribe to ICT Market Theory. And if you'd like to trade alongside these exact setups, you can find the FXTNM account link in the pinned comment below. The market is setting the trap right now. Will you provide the liquidity, or will you ride alongside smart money today?